Yo, what's good YouTube? Welcome to another video. In today's video, I'm going to show you guys a full guide on how to actually start trading, whether it's Forex, crypto, whatever, just day trading, how to, like what it is, how to recharge everything. So if you right now don't know anything about trading, I promise you after watching the whole video, taking notes, maybe rewatching stuff, you'll definitely be able to get started, and it's going to like make your process probably way easier than just learning step by step on YouTube videos and making your own experience. So I got all the stuff packaged up in this video, and you can see already I have like 5 topics I want to talk about in this video. So the first one is going to be what even is trading, and the second one, how to read a chart, how to actually trade strategy breakdown. So the strategy I personally use right now, which is very simple, and also what becoming profitable actually means, because as you're starting as a new trader, you don't know a lot of stuff like uh, for example, you don't know that it actually takes a good psychology and off chart things to make it as a trader. So it's a lot of stuff coming like from my side to yours, but I think all you need for this video is just your notes. Just take notes, rewatch something if needed. As I said, I would say just like let's just get started with what trading is. So I wrote a little definition here. You see, trading is just buying and selling assets like stocks or crypto to make money from the price changes. Let's do a quick example. Let's say it's just an example, okay? Let's say Bitcoin price is at $10,000 right now, okay? And now you want to trade it. You can, first of all, you can invest in it, where you just buy and hold it or something like that. Let's say you just buy a little bit of Bitcoin and then you hold it on your wallet. That's investing, okay? Trading is a little bit different, okay? Because when trading, you can kind of try to predict something is going to go up, which is a long position, but you can also bet on it going down, which is a short position. So you can make profits from market going up if you predicted it right. You can also make money from it going down if you betted on it. So let's say, as I said, Bitcoin is at 10K right now, and you bet that Bitcoin is going to go up even more, and you open a trade, which is a position. Like you can open a long position or a short position. A long position would mean, as I said, that you predict price is going to go up, and a short position is you predicting that market is going to, like, the 10K Bitcoin is not going to stay at 10K, it's going to go lower. Let's say you predicted it's going to, the strategy told you it's going to go up to like whatever number, 15K, something like that, and you go along, you enter a long position, you open a long position, and let's say you opened it with $1,000 because you have $10,000 in your trading account. Yeah, there's a lot of like more stuff to it on what trading accounts and how to trade if you don't have enough capital, like me, to trade a personal account, a big personal account. It's all going to be in this video, don't worry, okay? So you have a 10K account, let's say, and you open a trade with $1,000. If Bitcoin is at 10K and you go long on Bitcoin, that means you predict that it's going to go up, and it actually goes up to, let's say, 20K. That means you made just 100% on Bitcoin. That means your $1,000 turned to $2,000. So you're up 100% on that position. Now you could, if you're, let's say you're trading on just a crypto trading platform, and you can see your position. You entered with 1K, you opened the position with 1K long position, and it's going to show you like unrealized profits or just profits 1K, because you know you're up on your trade even another $1,000. Let's say it was only going up to 15,000, then you would be up $500 because you entered that trade with 1,000. It's pretty simple. And of course you can decide what amount of your account you want to risk. That's risk management. As I said, we're going to go over it, don't worry. So how do traders actually make money? We said it, just like traders on a day-to-day basis, like they can be day traders when they, while being in one day, they enter trades and they exit trades, and they, you know, just make their profits or their losses, whatever. But they can also be swing traders. So swing trading means you hold your trading positions over a longer time. It could be many hours, it could be many days, or it could be many weeks. What I personally do is day trading. I scalp. Scalping means you're in a position for a few minutes and then you're out, like you're just out then. So yeah, so you just have a little understanding of how, like how you can even trade. You can, as I said, just trade for short time trades and long-term plays. Okay, so short-term plays or long-term plays. And all these words, if they're new to you, just write them down, take your notes, rewatch, as I said, a little bit. If you have to rewind, then rewind, and just because these words are not yeah, these words are important and necessary in your trading career. Okay, so now that you know how trading is making people money, you have to know how to even get actually started. So how you can get started is by let's say downloading TradingView. TradingView is the app where you can see all the charts, whether it's crypto charts, whether it's forex, stocks, whatever. Okay, and all these markets are actually to trade. They're the same because you do, like, if you once know, like if you know trading, then you can trade with whatever market it is, like stocks, crypto, forex, whatever. It's just they are different. They have a little, they have some tiny differences, but once you understand trading, then you can actually trade any of them with a backed up strategy, if the strategy works good on the pair, of course. And then also, just in this whole video, like it's going to be a pretty long video. I'm just going to give you, if I now, for example, I remember something I want to mention, I'm just going to mention it. Like for example, that there are of course times on the day where you want to trade and where you don't want to trade. Or you can also, we mentioned it a little bit before already, you can also get started with trading when you don't have thousands of dollars of capital. So of course you don't have to have like several thousand of dollars, but it would be nice if you have a, or it is not, it would be nice, you should be having a income stream to fund your trading process. But there's something called prop firms. These prop firms, let me give you a little example what these prop firms do. Okay, so let's say a prop firm called FTMO, which is one of the biggest right now, gives you 10K, bro. Hold on. This quality is not. So the prop firm gives you a $10,000 account to trade with, and that means that you can use these 10K to actually trade. But because if you're using a prop firm account, which is not real money, which is kind of demo. Demo means like demonstration accounts where you can just practice. Because if you're buying that 10K demo from a prop firm, you can actually make real money from these fake 10K by just proving yourself as a trader, proving that you're able to trade, that you're profitable. How do you do that? So let's say you buy the 10K account, which is around, I don't know, $80 or $90, something like that. I don't know what the prices are for FTMO right now. I don't use prop firms anymore. I use my personal accounts with real money. But this I also started with this prop firms, and it's a very good way to start with. Let's say this is yeah, like $80, okay, bruh. This is $80, okay? And what they want you to do is bro, this shit is so looking, this is not looking good, bro. I'm just going to the euros. So what they want you to do is they want you to prove yourself, as I said. And how you're going to prove that you're good, they set you limits, like profit limits, profit targets, and loss limits. And once you reach those loss limits, let's say 5% a day or 10% overall, then your account is gone. Does that mean you have to pay them 10K? No, just your money which you bought the account with is gone. If you actually pass the account, which is by hitting the profit targets, which is mostly like 8% or 10%. So over the course of a few days, let's say, you mastered you mastered a good strategy in the last months, and then over a course of a few days, you passed the prop firm challenge, the demo account, with 8% profit, and then you get another phase. This was phase 1, P1, phase 1 on that account. You get phase 2. On phase 2, you have to do that again, but with a lower profit target. So let's say you have to hit like 5% instead of 8%. They want to just make sure that you are able to trade, you know what you're doing, which doesn't work very well because a lot of people just misuse these funded accounts and keep using them and are not profitable. But we're not going to be one of them. You are not going to be one of them. And phase 1, if you pass phase 2, this is phase 2. Then after you pass phase 1, you get phase 2. If you pass it as well by hitting the 5% profit target, you get a live account. Does that mean you get real 10K? No. Does that mean you get a real account where you can actually withdraw your profits which you make on the 10K? Yeah. So then you get a live account. Live account, and on that live account, it's still kind of a demo account, but as I said, whatever profits you make on that account now, you can withdraw. Let's say it's a 10K account and you make 5%, which is $500. You could withdraw these $500. Now, like you see, it's clicking because this is only example of a 10K account. What if it's a 100K account? What if it's a 200K account? All these big accounts, all these 6-figure funded accounts. And if you're actually a profitable trader, like a money glitch, because you can use little money of yours to make more money from the prop firms, from the challenges, from the this is called a funded challenge. So it's a 10K funded challenge where you prove yourself as a trader in 2 phases. Sometimes you can also buy things with 1 phase only, but it's like with less risk and more profit target and all that. You prove yourself in the challenge, and then you get a live account where you can make profits and withdraw. It sounds too good to be true, but it is actually real. But it's also not that easy as it sounds, to be honest. It requires a lot of discipline. It requires a lot of work, and it doesn't happen overnight, definitely, because trading is something, it definitely needs longevity, so if that makes sense. So you have to think long term. You have to be someone who thinks long term, and if you're not, you have to become someone who thinks long term. Because trading, the first few months or maybe the first whole year is just learning and, you know, finding your path, if that makes sense. So now you kind of know what trading is and how you can even make money, but you don't know how to read a chart yet. And I did it on purpose just so you know, before even learning how to read a chart and getting confused that much and just clicking off the video, just so you know that you can actually make good money off that. You can make unlimited money off trading, because these markets are like hundreds of billions dollars big, and you can just print a little tiny percentage off that and you're good. Okay, so as I said, I did it on purpose because I didn't want you to click off that video just because it's looking too confusing. And now I'm going to show you how to read a chart. And bro, trust me, it like with everything in life, first you have to be the dummy. First you have to look, you know, just dumb and just the one who's not very smart to actually learn something. So you see, I opened tradingview.com. There you should sign up probably and make it count. And once you sign up there, the first thing you're going to see is probably something like this. It's going to look like this. What you want to do is right click on these what is it, like on these things here on this indicator. It's called indicator, and you press remove because we don't need that. And now you can see a lot of so-called candlesticks. Green candlesticks, red candlesticks. It's just up and down, and I'm going to explain you what all that is. You can also go here, right click and show, and you know, just disable it. So we have a cleaner chart looking, and yeah, it should be looking something like that. Don't be confused too much but by all these tools. These are just tools to mark things on charts, to do the technical analysis. You can do fundamental analysis. So people trade off of economy and news, which are coming out because news affect these markets heavily. So if some let's say Trump says something positive about crypto, something very positive, then Bitcoin is probably just going up, and you can trade that news event of Trump saying something positive, or you know, so you can news is, or if someone says something bad about a specific thing, something can crash as well. So you can also trade that. You can short that, or you know, we don't want to trade news, but I'm just explaining you. There's fundamental trading, economy and news, I just said. And then there's fundamental, what is it called? Technical analysis, technical trading. Technical analysis is not like fundamental analysis off of news and economy. Technical analysis is just by using what you see on chart, by just doing something on the chart, only using the chart. Of course, we're going to check news as well, always, but guys, this is always like, I don't want to confuse you guys. We're going to get there step by step. So you probably don't know what these candles mean, what this up and down means. You can drag this here and move it to the right, and you don't know anything about it yet. And it looks so confusing, like you're going to fly a helicopter now for the first time. But trust me, it's not. Let me explain you what we're seeing right now here. I drew this also. If you're not seeing this on your chart, then don't worry. So what are we seeing on TradingView? This is Euro USD. What is Euro USD? It's just a currency pair, which is a Forex pair, okay? Forex means like currency pairs and all that, which you can trade. TradingView is not to trade though. TradingView is only to look at these charts and analyze and just view these charts. So euro US dollar is a pair, and let's go to the current markets are closed right now because it's what day is it? Saturday. I don't even know what day it is. Like forex markets close on weekend. For example, crypto, Bitcoin market, like if you just see Bitcoin is still moving, you see these numbers and crypto and all that. So markets right now are closed, but you can see the last price rate we had was 1.09625. What does that rate mean? It's nothing too confusing. It just means that the latest price exchange rate between the euro and the dollar is this. That means 1 euro gets you this amount of US dollar. Simple as that. You don't even want to know too much about what you're trading, who built this market and all that. You don't even need to know all the in-depth unnecessary stuff. You just want to you just need to know what we're doing, what we're seeing on chart, and what we're going to do to make money. Because making money is like the main thing we're doing here right now. Why are we trading? We are trading to make money and to get financial freedom. You are doing that because I am already on a very good path, and I retired my parents already doing that. So how you're going to read these candles, so-called candles, I'm going to show you now. Oh no, before that, what are we seeing here on TradingView? As I said, the pair, you can click here and you can search for another pair. Let's say GBP USD, which means Great Britain, British pound, British pound and US dollar. If you go there, now it opens this currency pair chart, and the last rate was 1.28987, which means you get this amount of US dollar for 1 British pound. And that's not even really relevant, like what the number is, what the rate is right now. We just want to trade the changes, okay? So if it goes up or if it goes down, something like that. We're going to go back. Well, let's say let's even go to BTC USD, which is Bitcoin. And just to, no, we're not going here, bruh. I have my things drawn on the Euro USD chart. So, also, what more you can see on the TradingView chart? Ignore this. Just you can see this is the name. This is the currency pair name, as I said before. Here are all the tools. Let's say you want to draw something like this, then you can do it like that. Boom, you see I draw something like that. Or text, you can just click it and then just type something. Or more tools. These are confusing to you probably right now. And up here, this is very important. Why? Because these are the time frames. So what do the time frames mean? Right now, you see we are on a 15. You see 15 minutes. It says 15M. 15M means 15 minutes time frame. What does a time frame mean? The time frame means that every candle you see here right now is reflecting and showing us 15 minutes of what price was doing, where price was going, the rate. You see on the right side, you see how the black number, how the thing is moving, because you know, we're going up and down, and you can see on the chart, like, I don't know if I have to explain it so crazy simple like you guys were kids, but I hope you guys are already understanding what I mean. So let's say you look down. If you look down, you see the time, okay? So 8:45 p.m. this candle, this green candle, was going up. And then 15 minutes before, see, to 8:30 p.m., 8:45, 8:30, 8:15, 8. Every candle, you see, I move from candle to candle. It's 15 minutes of like difference from each other. So this was moving for 50 minutes and forming and showing where price is going, where the rate is going. And so like every candle here does for 50 minutes. If we change the time frame now, let's say to 1M, it's going to show us the same thing actually. So let's say, you see how we're going down here? How we're going down? If I go to the 50-minute now, you see, I marked this just out on the 1 minute, but you can see on the 50-minute as well, a little bit, that it's showing us the same thing, but just in different perspectives. So this is the 1 minute perspective. Here you can see way more candles. Why? Because it's 15 times more candles than on the 50-minute time frame, because every candle is representing 1 minute. Okay, so 1 minute of price action. Price action means just where price is going. Price is moving, price is acting, and it's just moving. So now I'm going to show you how to read these candles, because you don't know yet. I'm back starting. Okay, so you can see you can see a red candle and a green candle. This is called a bearish candle, and this is called a bullish candle. Maybe you ever heard that word with crypto or something like that. Bear and bull, bearish and bullish. Bearish means something going down, and bullish means something going up. That's it. That's what you want to note down, okay? So the bearish candle is showing you a price rate when it was dropping, or when it is dropping right now. So you can see the candle opens, goes down somewhere, and closes. Give you an example. You see this candle, let's say just this, okay? Only look at this one right now. This candle, you can see it's a bearish candle, which means it opens up here and closed down here. You can see that now because it's past price action, like it happened. You can see we are on the 50-minute time frame, so every candle is showing us 15 minutes, and these 15 minutes price opened here, which is just like these candles are just on chart. Price was, you can see, they're 1.09909 at the rate at that time, and then it dropped down until this point, and then we opened a new candle because 15 minutes was over. So every 15 minutes you're going to see a new candle creating on the 15-minute time frame. You see this candle opened up here. Let me zoom in even. Up here it opened, and down here it closed. That's what you want to know for now. Also, you can see these sticks. What are these sticks? These sticks are called wicks, actually. So it's just like a candle and a wick. Okay, so the candle, the body, this is called the body of the candle. The body of the candle is showing you where we're going right now with the price, or what the price rate is. And on the bearish candles, this is the candle open. Like, it's pretty simple. I don't want to even take too long on explaining that. This is the point the bearish candle opened, and this is the point when it's someone closed, candle closure. And the other way around is for a bullish candle. Bullish candle opens down, like on the, down somewhere, and then it goes up because it's bullish. It goes up and closes somewhere up. And that's the candle closure then. And the wicks, we were talking about the wicks. They're differently big. Why? Because I'm going to explain you later. So these wicks show you the highest point of this time, let's say it's a 15-minute candle, of these 15 minutes, which was the highest rate we went within that 15 minutes. And that's the same for both. Like, you can take a bullish or the bearish candle, and the same with the downside. The wick, like on the bottom, is showing you the lowest point it ever was within that time when the candle was creating. And let me show you even, can I somehow show you a live? Okay, I'm going to replay mode, and I'm going to show you well, okay, so you see, let's say, no, I'm going to replay mode means that I can replay how the price was moving. Okay, so you see, this is a bearish candle, and this before that as well, and this is a 15-minute time frame, which means it's right now, these 50 minutes, 4th April, 4 p.m. it's going down right now. The rate is going down. And then now I'm going to play it a little bit forward. Now a new candle opened. Now it's just fast forward everything, of course. It's not 50 minutes actually. You see, the candle opened right here because 50 minutes for that candle was over. The new candle opened right here at 4:30. The next candle after that is probably then going to open at 4:45. 4:30, a new candle opens. This is the candle open. This is the highest point it went. And this is the point it is right now. Let's play it out. Boom. Now the next candle opened. This candle is done. This candle's lowest point was this. With the where it closed, my bad, where it closed, and the lowest point was this wick. That's kind of it. And the other way around with the bullish candles. So let's take a big one. No, did he? You see, we replay even more, we rewind in that price action even more. It's just like to practice. A lot of people replay it. You see, this is a bullish candle. Bullish candle means on the downside they opened here it opened, the candle open, and here it's about to close probably. If we now, you see, next candle open, and this is closed now. These 50 minutes are over for this candle, and it closed right here, and this whole body shows where we went. We opened here at, you see on the right side, 1.09753, and went all the way up to 1.09842. And the lowest point we ever went with that candle was around here, and the highest point was, you see, the wick around here. That's kind of it. That's really it with these candles. I know it might start being a little, or it might seem a little complicated, but once you got it, trust me. And you just have to replay what I just said before, how I explained it, so you take notes and you have your own understanding of this. And all these candles next to each other are just showing you where price is going. And as I said, here are the time frames. You can switch perspectives. So let's say you go to the hourly candle, and that's where like the traders who are in trades for longer time look at. So I am trying to take a trade and being out in a few minutes after, so I'm trading a lower time frame. These are the lower time frames, like the 1, 2, 3, 5, 10 as well, kind of. Not 10, not really. 1 to 5 is lower time frame because it's showing you more candles and what is happening in the last 1 minute, like what candles did with every, like in every single candle. And like higher time frames, we say it's like 1 hour, 4 hour daily. Daily means then that every candle is a day. So you see, this is the 4th April, 3rd April, 2nd April, 1st April, and these represent a whole day. Of course, if I go now to a lower time frame, I can see the same thing as well. Let's say to a 4 hour time frame. You see, it's the same move, but it's showing me it with more candles, because it's now on every candle is showing 4 hours. It's really not that hard. It's really simple, actually. You just once have to understand it. And yeah, that's kind of it, how to read a chart. Now we just have to combine everything, all the candle knowledge, and try to understand trends as well. This is also very easy, because let's say we're on a 15-minute time frame right now, and you see just looking where it was going. So you see here in the beginning, like of what I'm seeing right now here, you see we were going up, we're going up, going down, and up, down a little bit, and then more up. And then you see until this point, let's say just marking out, looking at like this now, okay? Looking at this, you can see went up, a little bit down, up more, a little down, up more, a little down, up more. So when we are making moves of big up moves, little down moves, big up, little down, big up, this is called an uptrend. Down move, little up, down move, little up, down move. This is called a downtrend. Don't even want to overcomplicate it. Simple as that. You could say this is a little not very clean, but this is a downtrend because we went down, went up, we went kind of even more down, let's say, just we cheat a little bit here down, and then now we don't know yet. Going to show you a cleaner example of a downtrend now. Hold on. Let's say, yeah, this sounds good. This looks good. So we're still on the 15-minute time frame, which is zoomed out right now a little bit. Yeah, here. You see? Oh, my bad. Hold on, guys. My bad. You see? Here we're clearly going down. Like, yeah, in between there are up moves a little bit, but see, main move down, a little bit up, down still, a little bit up, down. A little bit up, more down, equally up actually, but then more down, and then slowly going down and down and down. And you know, if we take this now, this drawing, you can see, my bad, it was going actually down. So we started here and went until there. So downtrend, uptrend, I think this is one of the simplest things. You see, this is also just like going straight down, bro. We call that bearish price action and bullish price action. So if I open chart and I see something like this, let's say you look at the time down there, you see 10 a.m. and then after a few hours I look back again on the chart at 3 a.m. After opening chart at 3 a.m. At 3 p.m. my bad, at 3 p.m. I would say, damn, chart is looking bullish, which means we were kind of going up. What I see at 3 p.m. here until here is that we went up, so we went bullish. Okay, simple as that. These few words like price action, bullish, bearish, candle, body, wick, that's it. Like, to read a chart, it doesn't really take much. It just needs a little practice to understand these candles that we actually, I don't even want to cut out and edit on that video too much, or my editor to do that, because I want it pretty raw. No Diddy. I like it like that because it keeps everything simple and you can easily rewatch. And I just want it to be like how I am. I don't want to have it too perfect and all that. I just like how it is right now. So how to read a chart is done now. Like we kind of already talked about what trading is, how to read a chart. If you need to, watch the video again. Also, I have a beginner's course like as a playlist as well on my YouTube channel. You can just go to my channel and look up for Road to Glory. There's a second part right now coming out slowly as well. But I recommend, if you struggled with how to read the chart, you watch the video there. There it's also explained pretty good. But just in this video, you get everything as a package, because also explain like what trading really is and all that stuff. So how to actually trade now. I explained to you before, you can trade prop firms, but you can also trade personal capital. Obviously, you don't have the personal capital because you're trying to make money for now and you don't have much. You should have a little bit though, to, as I said, as a working job or something like that, because that's what I did as well. I started jobbing at like 13, 14 actually, and saved up money, and then started. Right now I'm 18, by the way, and I started at like 15, 16 with trading, and then I never looked back. I just locked in. I know, like, if you're watching this right now, and you're still going to school as a student or working job, or you have friends, and if you're alone in this and your friends are not interested in something like that, bro, you're going to speak a whole new language once you understand all this, and you're going to be like, damn, all these people don't even know what this is. And you're not going to feel special, but it's just something like you like not everyone knows what this is, and not everyone can read a chart. If that makes sense. So never mind. How to actually trade. We said prop firms is a better option for you right now, because you can give a prop firm a little money, let's say $80, $100, $200, for them to give you a trading account, which is demo, yeah, but you can prove yourself that you're good at trading, and then you're going to be able to, let's say you buy a 100K account, you can trade that 100K like it was real 100K in order to make profits. So you make profits on the 100K. Let's say you make 3%, which is 3K. You can withdraw these 3K. Of course, you can make losses on that account as well. And losses, I want you to normalize that completely, because losses, you're going to see many of them as a beginner trader, bro. My back is hurting right now. Losses, you're going to see many of them. It's not something which sometimes maybe happens in trading. No, it happens regularly. It's part of the game. It's the game, like losses and wins. At the end, it only matters to become profitable, to be long-term profitable and making money. It just matters that the frequency, like you get more wins than losses, which is going to make you obviously more money, if that makes sense, or your wins are bigger than your losses. So either you have 6 wins and 5 losses, and you made, let's say, 1% on each, which is 5 losses, 5% down, 6 wins, 6% up. 6 minus 5 means 1% up. You're 1% up. Or you, let's say you win 4 trades only, and you lose 6 trades, and you lost 1% on each trade. So you're down 6% now. But on the winning trades, which 4 wins, you made 2% on each win, which is 4 times 2, 8%. So you was down 6%, but on the wins you made 8%. So on, like, the single wins are bigger than the single losses, if that makes sense, in this example. So the wins, even though it were only 4 wins and it was 6 losses, the wins made you more percent gain, which at the end was 6 minus 6 and plus a, plus like a minus 6 means then 2%, so you're still up 2%, even though you lost more trades than you won. So it's just, as I just said, either your wins are bigger than your losses, or the amount of wins is bigger than the losses, if that makes sense. We're going to switch the camera now to a different location because very soon I have to check out. It's my last day here in Dubai right now. Been here now, and yeah, and then we're going to get how to actually get started and break down my strategy after slowly, and then becoming profitable, all the psychology sauce, which is the main stuff. Okay, but I hope until now you've like learned something, and I hope you did. I actually know you did, because it's a whole lot of like, now you already know how to read a chart. And if not, then just rewatch. And if not, then just go to Road to Glory and watch Road to Glory Day 1. Because you got this. I know you got this. I know this looks confusing, but you got this. And then see you when I show you like a little breakdown of point 3 as well. Okay guys, we're going to move on like nothing happened. Onto the third point, how to actually trade. I already prepared something here. Where is it? Here. Okay, how to actually trade now. Now you know how to read charts. Now you know how to read candlesticks. Now you know when you open TradingView what you see, and you know, like just what price action is, what the time frames are, which is very important. And now we're going to talk about how to actually trade, and we start off with knowledge on chart. I'm going to show you a very simple candlestick formation, and it's kind of the only one you ever need, which forms the highs and lows. Let me explain you what that means. So we talked about before that, where is it? Oh man, it's already gone. But we talked about before that these are the candlesticks. This is a bearish candle, this is a bullish candle, and this is a bullish candle, and this is a bearish candle. So that's already what you know. Now let me cook real quick. Now we're going to look at a candlestick formation, which is formed by 2 candles always. Here you can see this candlestick formation. I'm going to just keep it very simple. A bearish candle followed by a bullish candle forms a low. Okay. If the candles, if they don't have wicks, then you just mark out the whole low like this. And if it does have wicks, like in this case, then you mark out the lower one. Now you marked out the low. Let me show you an example. Already did it a little bit here. You see, bearish candle followed by a bullish candle forms a low. That's how you mark out the low. Before that as well, you see a bearish candle, this one, and followed by a bullish candle, this one, forming a low, which you mark out like this. Now if the green candle, the wick of the green candle is lower than the red one, then you just mark out, let's say like this. You see, bearish candle followed by bullish candle. You take the lower wick and mark it out like this with the trend line tool, and then you have marked out the low. That's it. Like, that's the first candlestick formation I wanted to show you guys. And I hope it's very simple and understandable. Now I'm going to show you the high one. It's literally the opposite. So if a bullish candle is followed by a bearish candle, then we call it a high, as you can see. And the same thing here, you can just you have to just mark out the higher wick of that, like that, and then that's how you mark out a high. So a low and a high, that's the candlestick formations you learned now. Let me show you some high examples. Here you can see, for example, that bullish candle followed by a bearish candle. These two form a high like this, the higher wick. I mark it out like that. And of course, like highs and lows everywhere in the market. You can see, like I can just literally see that through everything. A low, a low, a high, a low. My bad, not like that. Like that. Like there's highs and lows literally everywhere because, you know, everywhere there are bullish and bearish candles, and if they follow up on each other, then it forms highs and lows. But why are they so important for us now? Because if we get later to the strategy breakdown, we're going to learn what liquidity is. You'll learn that, no worries. Now, before getting to the strategy breakdown, I'm going to show you the tools real quick. So here you have the horizontal ray, which is just like that. Hold on, it's white. You can see it. Yeah, which is just infinite line to the right side, which is good. You should have it in your favorites. Then the brush to just draw something. The rectangle is very important. The vertical line is also good. And the most important ones, which I wanted to show you guys to teach you something, is long and short. Long and short position you will find here. You can find all these tools here, and just get you see, just copy what I did here. Stop the video and copy it. You see long and short, okay? So the long position literally means that when you're about to look for a trade, what your strategy tells you to look for a long, then you use the long tool position. If it's about to be a short, then you use the short tool position. Short position tool. That's what I meant. And that's literally only two things, which the position tools are showing us. The long position is showing us the stop loss, which is the point which you set by yourself, where you say, okay, if that point hits, I want to be out of that position because the trade didn't work out for me. Yeah, and that's like the stop loss, which has, of course, which you can set up the risk for. So let's say just randomly, okay, completely random. You say you want to go long at this point, okay? At this point, when this green candle appeared, you wanted to go long, and you wanted to put your stop loss right here, okay? And you have your TP, which this is the green part is take profit, which you can call also TP. You have your TP here, but before hitting your TP, you can obviously see the stop loss got hit. What that means is you had a certain amount of your account, which is for the prop firm accounts, which you're going to use probably always around, like the recommended risk per trade on prop firms is 1 to max 2%. So you can decide what risk you put in the stop loss, of course, and that's all risk management, which you're going to learn in the video later. So this is the long position tool, and the same here for short. That's the position tool we're going to use when we're looking for a trade where we predict that price is going to go down. Let's say you predicted here that we're going to go down, and you place your stop loss on this high. Then you targeted for these lows or something like that, and your TP, your take profit, got hit here. Yeah, that's how you use the tool. And of course, you're going to learn how to exactly use the tools when you learn the strategy. But these tools are just very important for you to know, especially now on Forex, on Euro USD. You can see, let me explain you what these numbers here mean. So you can see the risk reward ratio, okay, which is very important for us. Let me show you, okay. This 50.7 means pips. This 50.7 means pips. So right now this TP is 50 pips. If you make it smaller, you can see 40 pips now, 30 pips now, and this one, the 304, you call points. So 304 points that is right now. And the higher time frame you go, the more pips you're going to see for your stop loss or take profit, because you're using a bigger area. Let me show you what I mean. So you see, if I place a stop loss just randomly, the position tool just randomly now, you can see 50 and 50. And if I go to the 1 minute time frame now though, and I just put it here, you see it's way smaller because the area and the time frame is just way smaller. But you're going to understand that, no worries. And what these pips mean is just like the size of the stop loss, if that makes sense, or of the take profit, just of the position for you to know. But the very important thing, which I already told you before, is the risk reward, which is goes for both, of course. And the risk reward means how much you're risking, how much you're looking back. So just very, very simple said, again now, is, let me lock in, let me cook now. You are risking in your stop loss X this amount. So very, very simple explained what the risk to reward means. The risk to reward ratio, it means what's in your stop loss times the number which is said here is what you're aiming to make. So let's just say in this stop loss you put $100, okay, like this, or bro, let me just cook up with euros. So you risked 100 euros on a long trade. Let's just do an example, even just a very random example without a strategy. Let's say you went long here and you put your stop loss like this and your TP on 1 to 2, which means you are, let's say you were risking again 100 euros. I cannot find the euro thing, so I'm just going to use dollars now. You risk $100 here. How to risk that, all that is risk management. I told you even before that we're going to learn that in the video, but just so you know that you can, on the platform you trade and the account you trade, you can decide whenever entering a trade how much you want to risk on that trade and where to put your stop loss. So it's not very complicated. You risk the amount you wanted, which is $100, in order to make 2x of that. You see, this red area is half the green area is, which means the green area is 2 times as big as the red area, which means you're aiming to make, if the TP get hit, if the take profit gets hit, you're going to make $200. Simple as that. If the risk to reward is 3 now, then you're going to make $300. Why? Because your risk to reward is 3, which means your stop loss times 3 is what you're making back. If it's 1, if your risk to reward is only 1, guess how much you're making? Exactly $100, because you're risking 100 times 1 is what you're making back. Risk reward is literally very, very simple to understand, and it's the same thing obviously with the short position tool. And what I can tell you is, if your strategy has high risk to reward on average trade. So if your average trade gets you 1 to 3 RR, which is considered as pretty good and high, then your win rate is not going to be very high. And if your risk to reward on average is pretty low, like 1 to 1 or 1 to 1.5, let's say, then your win rate might be pretty well. Still, you have to count in some losses all the time, especially when you're learning and a beginner. So now that you know what risk to reward means and you know how the position tool works, just so you understand, TradingView is really just where we analyze and draw things. TradingView is usually not where you trade at. You can trade on TradingView, but I'm going to show you how to start without trading on TradingView, because I want to show you the simplest way to start, and which I use as well. And for that, you will need, I'm going to count that into how to trade actually as well. For that, you'll need TradingView for analyzing. As I said, already make an account, or it would be nice if you buy the first like option there, the first plan, which is not very expensive. I think it's like $10 to $20, I think. So TradingView, you'll need a notebook where you take all your notes also from these videos. You'll need MetaTrader 5, which is the app where you're going to trade. So account to trade is when you're starting off, and when you're a beginner. As a beginner, you're only going to need a demo account, which is demonstration account, which is an account with basically fake money, just to train and practice your trading skills. And yeah, the demo account is where you're going to trade for the first 2 to 3 months just to see and learn. And so that's why you don't have to worry about account to trade yet. But account to trade, usually you get either through your broker, which I have, through my personal account. They give me the account, my broker gives me the account, which I then log in on the platform to trade. And the platform to trade I use is MetaTrader, as I told you, which is the best for me. And yeah, you are going to get your demo account to trade on MetaTrader directly if you just download it, and then you're going to see it. And very important, besides the knowledge on chart, besides the trading strategy, kind of including already the trading strategy, is a trading plan. It's very, very good that you already, as a beginner watching this video, because you're going to skip so much useless shit and, just getting onto the real deal already. Yeah, a trading plan. A trading plan is so important, because if you don't have a trading plan, if you don't take notes and kind of journal, we're going to get to what journal is later as well, then you're just gambling. Because you might have heard already a lot of times that people say trading is gambling. No wonder why they say that, because a lot of people, or the most of the traders, are actually gambling. You cannot even really call them traders, but the people who are trying to be traders, they're actually gambling, because they have no plan what they do. They trade just random shit every single time, and they just keep moving even though they don't see any results, and they don't refine what they do. They don't learn from their mistakes. And as a trader, you have to be a learner all the time. Even I do mistakes still. Even I make mistakes still. Even though I'm a very profitable trader and very soon about to be 7 figures big on the personal account, I make mistakes. And even millionaire traders I know, they also make mistakes. As a trader, you cannot make mistakes. You cannot not make mistakes. That's what I'm trying to say. So learning and trading is so essential. Dropping your ego to be ready to learn, and knowing that you cannot be right all the time. So if you're a person who has a big ego of being like, No, it's not my fault. It's not my fault. It's your fault. Welcome to the markets. Welcome to trading. Yeah, it's the shit. It's just because people with ego problems start trading and think they're going to they're just different, and I'm so different, I'm built different, I'm going to be profitable in 2 months. Then they get their Canon event. The Canon event is always some wins or maybe even passing funded accounts, and then they think they're that, like, they are really him, but they end up being unprofitable because they got overconfident. That's it. So now we're coming to the strategy breakdown. Now it's a really fun part. So you just learned what a high and a low is, right? Now you're going to use that knowledge, which is fundamental knowledge, for the strategy. Now we're going to use it for the strategy. So you just learned what a high and a low is. We're going to start with bro, where is this? Oh shit, it was a higher time frame. Yeah. So you just learned that. We're going to use it now on chart, but we're going to use it as liquidity. So you have to understand that highs and lows are literally everywhere. You see this, like everywhere where there are two candles with different colors. Either it's a red candle followed by a green candle, or you see green candle followed by a red candle. It's all highs and lows. But now we want to take the highs and lows which are standing out from the rest of the highs and lows and going to mark them out like I already did here. You see this? I'm going to just do it a few times now just so you see, like this, or maybe even like this. You see? So little sentence for you to note down in your notes to understand. Every liquidity, this is what liquidity is. This is what we're talking about. We're going to get even more deeper into that nudity. Every liquidity is low or high. You see, this is bullish liquidity because it's a high, and this is bearish liquidity, like a sell side liquidity and buy side liquidity. Let me write it down quick. So, bro, my throat is hurting literally right now. Buy side liquidity. Buy side liquidity means it's formed by a high, bullish candle followed by bearish candle, standing out, buy side liquidity. Bearish candle followed by bullish candle, standing out, sell side liquidity. Low, standing out, sell side liquidity. High, standing out, buy side liquidity. That's it. So, yeah, what was I about to say even? Like, this is so simple. I don't even know how to in-depth explain it. I'm just going to just mark out stuff until you understand it. And yeah, the sentence I wanted to tell you is every liquidity is either a high like this or a low like this, but not every high or low, which are everywhere in the market, is liquidity. So liquidity is always highs and lows, but highs and lows is not always liquidity. That's what you got to note down. I'm going to give you now a really good example of this. This is a very good buy side liquidity. Well, this isn't buy side liquidity. Let's take the higher one. This. Why? It's the same thing. Bullish candle followed by a bearish candle. Bullish candle followed by a bearish candle. Yeah, because this high is standing out, which makes it a liquidity. This is just the same as the other candles around and kind of not really spiking out. Like, it has to spike out like this, then it would have been liquidity. And the more it stands out like this, bro, this is standing out so much. This is very strong sell side liquidity. This is not very clean buy side liquidity, but let's say Let's say even this one. Let's say even this one. This is good buy side liquidity. Bullish candle followed by a bearish candle. Makes it a high. Standing out makes it liquidity. Buy side liquidity. That's it. And if you need help with this, just again, already like before, I already told you, watch the Road to Glory where I in-depth explained how to spot liquidity in the market. But I think by just even rewatching this video and this part where I explain liquidity and highs and lows and all that, sometimes you won't understand and you will get stuck. And that's the same for me as well back then. That was literally the same. I thought I'm just too dumb enough to understand something, but I rewatched some trading videos which were like 30 minutes for 5 or 6 times literally in a week just to get something into my head, and then after be like, bro, how was I not understanding this? This was so easy. You see, this is literally the fundamental of my strategy, because liquidity and imbalance, if you guys know, is what I preach all the time. So liquidity and imbalance is the concept I am liquidity imbalance. Like literally Glory Trades represents liquidity and imbalance. If you didn't know, on TikTok and all that stuff, my content is literally that. Why? Because this is literally what you need to become a profitable trader, strategy wise. So if I say liquidity and imbalance all you need, doesn't mean you trade it and you're profitable instantly. Of course, you have to put in consistent work, and not always, like people think when they are consistent, you just do a thing over and over again. Even if you fail, it doesn't matter. You just keep moving. Yeah, but you have to look at the work you're putting in. Is it the right work? Is it the work you're actually which is needed? So some people just know they're doing something wrong, but they don't want to change their actions because they're too comfortable with their current actions, and then they think it's consistency while it's just doing things wrong over and over again. So if you're consistent, make sure you are actually doing the right things to stay consistent in. Yeah, we're going to go over to from liquidity. Let's check out the things we just learned. The fundamental from the strategy breakdown we just learned. Liquidity, how to spot liquidity. Spot liquidity. Let's say spot liquidity. That's a little trading plan here already. Spot liquidity. Next step is spot liquidity sweep. Spot or wait for. So now you know how to spot liquidity on the 50-minute time frame. You could definitely go to any other time frame and see the same things, but we always want to go on the 50-minute time frame to spot these liquidities, and you're going to learn why and what for. But to spot liquidity, which is what you already just learned what liquidity is, we do that to wait then for a liquidity sweep. What is a liquidity sweep? I'm going to do a children version of explaining now, like very, very simple, like a kindergarten kid would understand what this is. Buy side liquidity formed by bullish and followed by bearish candle. Buy side liquidity, you already know what it is. Price action goes up, boom, boom. What did we did to that liquidity? Just boom, we swept it. We just went a little bit above and then changed directions, which means sweep. This is a buy side liquidity sweep. Buy side liquidity sweep. Now, if we have sell side liquidity and we do like that, that's not a W pattern. That's just a sell side liquidity sweep. Sell side liquidity sweep. No worries, I'm going to show you real-time chart examples now. Let me find some as well. Let's start with sell side liquidity sweep, what we just did here. No, buy side we did. Okay, let's do buy side liquidity sweep now. Somewhere where it's clean and not too much messed around. Okay, boom. I just found one pretty nice. So you see this bullish candle followed by a bearish candle formed a high, standing out a little bit. It's not very strong liquidity, but it is. You see, we mark out that liquidity. First step is done. Spotting and marking out liquidity. That's the first step. Now we see the sweep. We marked out the liquidity. We saw price going up and down again. This is a sweep. That's it. That's literally it. Hold on. Let me show you other example now. Somewhere probably. Okay. Damn, that's a good one. So you see this bullish candle followed by the bearish candle formed a high, which is formed just liquidity, okay? Not going to overcomplicate it now for you. This liquidity, this buy side liquidity, just got swept here very, very, very precisely. You see, price went a little bit above. You can zoom in and see price went a little above and then changed the whole direction, and that's a perfect sweep. That's what we call a plus liquidity sweep, because it's so precise. We didn't go up like this and then this. We went a little tiny, like what is it? Hold on. It's like not even a pip, like 2-3 points, something like that. And again, about the pips, you see, I told you this is the points and this is the pips, right? I think it's obvious, but just for you to know, 1 pip is 10 points. 10 pips is 100 points. Just so you understand. So 10 pips is 100 points, or just very simple for so you understand. 10 points is always 1 pip. So you understand that. So we got that out of the way. And that's all things you have to write down and note down. So these gaps you see sometimes, it's just a little weird, but no, let me find a better example even. Now we're looking for a sell side liquidity sweep, by the way. Yeah, this is pretty nice. The liquidity is not looking very clean, but it's still okay. You see this red candle, bearish candle, followed by a bullish candle, which makes this wick a low. Now this is a low and standing out a little bit, which makes it liquidity. It's weak liquidity because it's not standing out that much. These both candles have to stand out more than it will be clean liquidity. But the sweep was very clean. You see, we went a little below and then we swept it even with the wick. And you have to know the wick means that we went there and then moved pretty quick there, like away from there, which makes it a very precise sweep. Of course, you can have sweep with the body of the candle being here as well, like that or something. But yeah, let's just find more examples. We might even see that somewhere. But again, just looking for sell side liquidity sweeps. And I'm seeing not many, to be honest, right now. Yeah, right now we're kind of even back testing, which means just going back in time on chart to look for things, for certain things. Yeah, man, back testing is not fun at all. That's with trading as well. Like, it's fun to make that much money by just doing this little work, but you have to be patient so much. Like patience is so important. You guys have to understand. Sometimes just waiting for trades, waiting for your strategy to play out, waiting, or your strategy isn't giving you trades the whole week. This is all patience. Let's do a buy side example. You see buy side liquidity standing out, mark it out, boom. You see price going up, sweeping it, boom, changing direction, very nice sweep. Buy side liquidity sweep. It's so simple. I don't think we have to go in depth into that. And as I said, if you still struggle by even rewatching this shit, then just go to my YouTube channel and watch my sweep, how to spot liquidity and how to spot liquidity sweeps video. And then you're going to be good. Trust me. So we have, where is it? We have spot liquidity, spot and wait for the liquidity sweep. Now, the interesting part, the execution comes, okay? The execution is on the 1 minute time frame. So we're using 15-minute time frame for spotting the liquidity and waiting for a sweep of it, and changing to the 1 minute time frame. You can imagine it like that. You see liquidity on the 15-minute time frame, and you see price is slowly coming up, and you marked out already the liquidity. Okay, you marked out the liquidity already, and you're just waiting for price to reach that liquidity and to see, okay, now it reached it. Is it now changing direction, which makes it a valid sweep, or are we just going up more, which makes this not a sweep? This is still liquidity, of course, but this is just a takeout of this liquidity because we went even up more and did random stuff and not what we wanted, which is this sweep by just changing direction and giving us a trade, or maybe giving us a trade. But this part we are going to look for on the 15-minute time frame, which is the liquidity and the sweep. And then when this happened, when exactly this happened, you change to the 1 minute time frame where we're already there, but you know that this part is on the 15-minute time frame. This is what you want to see on the 15-minute time frame, right? I'm going to write it here real quick. 15-minute time frame. This is what it has to look like. And then if you switch on a 1 minute time frame, it's probably going to look like that. So this is the liquidity, this one, and you see market going up there. And now on the 1 minute time frame, okay, we're now in the 1 minute time frame. I'm going to just give you examples after this. You want to see price, as we just said, for it to be a valid sweep, we want to see price changing direction, okay? By changing direction, you want to see a little something to get a short trade. Why a short trade? Because we swept buy side liquidity. Whenever we sweep buy side liquidity sweep, we're looking for, where is that? Hold on. Never mind, I'm not seeing it. Buy side liquidity sweep, looking for a short position, and sell side liquidity sweep, we are looking for long position. The theory, just a simple theory, is liquidity in the market is everywhere, like literally everywhere, not as often as highs and lows, but liquidity is literally everywhere, like this. You can see very often. And the theory is that price, the current price, goes to untouched liquidity areas, sweeps them, and then changes the direction. And when it changes the direction, you want to go in on the move, on the change of direction. And the change of direction, we want to see something on the 1 minute time frame. We're getting onto that after that. After me explaining you what the strategy is about. The strategy is about the sweep, change of direction, giving us a trade in that specific direction, and then just taking our profits, and that's it. The other way around, when it's sell side liquidity, you wait for price to come down, sweep that liquidity, you make sure it's a sweep, and then you look for a long position because we swept sell side liquidity and we might change direction, to sweep more liquidity on the upside or something like that. And then you take it like that, you look to take it like that, and yeah, then you just find your long position. South side liquidity sweep, long position. We're looking for a long position. That's not always when a sell side liquidity sweep happens, you go long, or not always when it's buy side liquidity sweep, you go short, obviously. Yeah, I think it's just not too confusing for you right now, and you're not consuming too much information at once. You can just take your time, take notes, rewatch, everything chill. Okay, now giving you examples on chart of what I mean by when we actually know when to enter and all that stuff, okay? So, I want to give you a good example. No. How am I going to give you an example if you don't even know one very important confluence? Confluences are just confirmations for our trade. So a liquidity sweep is a confluence. And there is one more confluence to the strategy to enter the trade. So we already learned one, which is liquidity sweep. Liquidity is not really a confluence. Liquidity is just highs and lows. It's just part of the strategy. So you wait to look for, let's just break down the strategy again. 15-minute liquidity. 15-minute liquidity sweep. 1 minute, change of direction with a inverse fair value gap. What is a inverse fair value gap? That word sounds so difficult, but it's not. It's really not. First, I'm going to explain to you what a regular, like just fair value gap is. Fair value gap is the gap between the wick of a candle and the wick of the third candle. So wick of the first candle and the wick of the third candle. Let me show you a quick example. Let me even draw it, okay? So let's say we have this bullish candle which went to the upside, which is green. Just imagine. And then we after created another bullish candle which went up obviously as well. And then we again created a candle like that, which also had wicks like that. Maybe that's just the bigger wick, just randomly. And we just said we're looking for value gap, and fair value gap is the gap between the wick of the first candle and the wick of the third candle. This is the wick of the third candle. Yes, of course, this as well. But when we're talking about a bullish fair value gap, we're looking for 3 candles going like this, forming this wick, and the third candle, its wick like this. So I'm just, without giving you a very complicated explanation, I'm just marking it out. Now doing example to the downside as well, with like a smaller Fibonacci gap and then one a candle and then bigger, and you're going to see like a wick, boom, like that, like that, and you see this Fibonacci gap. I think it's pretty simple. You just want to see 3 candles and gap between the wicks of these 3 candles. If you want an example on chart, I got you. By the way, this is a bullish fair value gap, and this is a bearish fair value gap. Bullish means going up, bearish means going down. It's not going to be many of these confluences, don't worry. It's not going to get worse than that. So, just a very easy example of a bearish fair value gap. You can already see here, see a candle, a big candle, another candle, and it made a gap in between of these candles. They don't have wicks, then you just use the bodies like that. If they had wicks, we just put this box on the wicks. You see, first candle, second, third candle. First candle and third candle don't overlap with the wicks or something. So this candle doesn't have a wick like that, and this candle doesn't have a wick like that, which wouldn't give us the opportunity to mark out a gap. And here you see as well, even 2 fair value gaps back to back. But let's just say this first candle, second candle, third candle, first candle, wick, third candle, wick, which makes it a fair value gap. Simple as that. And again, after happened as well. First candle, wick, third candle, wick, boom, fair value gap. That's 2 fair value gaps back to back. You can even mark them out together like that, or like as a one big fair value gap, and you can just remove that. It doesn't get more complicated than that. And once you have this, you got it. Yeah, the color of the candle can vary. So let's say, even though this one is a bearish fair value gap, you're just going to learn by just seeing me how I mark it out all the time. And I want you, as like a little homework, to mark it out on your chart all the time too. Just you go on TradingView, you learn first how to spot, by just following the steps on the video, how to spot highs and lows, how to spot candlesticks, how to read everything and all that stuff before. And then when you get to that point with fair value gaps, when you're learning what fair value gap is, I want you to make a sketch like that on your notes, which I did here, like that, for understanding what fair value gaps are, and then just going on chart and looking for them. And as I just explained, this is a bearish fair value gap, but this candle is green. Does it still count as a bearish fair value gap? Yeah, because the candles at the end were like, the main thing is that it's going down, kind of. You get what I'm saying? The color of the candles don't matter, but if the candles are all the same color, so like this, let's say, you see this is a fair value gap. Like I can see these fair value gaps in my sleep. Like I can just literally mark them out like it's nothing, and I can see them all. I can see so many fair value gaps right now everywhere where you might don't even know there are fair value gap. For example, like this. And of course, the fair value gaps which are with the same colors like candle, they're stronger, but you don't really have to worry about that. First, just try to learn where and how to spot fair value gaps. Yeah, we just spotted some bearish fair value gaps. We just learned how to spot bullish fair value gaps. We can just find more examples, for example, like that. You see, candle, 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 3 candles, and between them is kind of a big gap, which you see here. Boom, like that. The fair value gap theory is that market moves so fast that it creates gaps, and these gaps, because market moving so fast, people, or not people, orders getting missed, and to balance out the orders, price goes back into these fair value gap to fill out the orders, or rebalance, kind of to balance out, and then goes away again. And that going away again is what we're going to use for the trades. And we said this is the regular fair value gap. And to not confuse you, what I preach all the time, what I said before, is liquidity and imbalance. Liquidity, you already know what it is. And imbalance, you also know what it is. I didn't talk about it, but I did. Fair value gaps are literally imbalance. That's what I mean by imbalance, or yeah, fair value gap is what I mean by imbalance. It's the same thing. Imbalance is just a main word for fair value gaps. That's it. So we just said before, we're looking for inverse fair value gap, right? Where was it? Yeah, here you said. Here I said it. 1 minute time frame, we want a change of direction with an inverse fair value gap. We learned about regular fair value gap just, and the inverse fair value gap is just, let's say you're going up right now with price, okay? We're going up, and while going up, it's looking like this. It's looking literally, hold on, let me wipe that out. It's looking like this. So we're creating a bullish fair value gap. When another candle, let's say, opens now, it could be later as well, like the third candle or a little bit later, but we want to see it ASAP. Let's say then after this bullish fair value gap is there, and you see another candle, let's say, let me even draw that again. You see another candle, and the candle goes now in like through that fair value gap and closes below. You see the candle closure is below. That means this fair value gap just got inversed. Okay, so I can just find a little quick example for that. Let's say let's say this bullish fair value gap. You see, we just learned how to mark out fair value gaps, which is first candle wick, which is not there, but you can still use the body as a wick. And you see third candle wick. You mark him out like that. You see, like that. This is the fair value gap. Let me zoom in. This is the fair value gap, okay? You see, you stretch out the margin of that, and you see these candles didn't close below the fair value gap, but this one did. You see this closure of this bearish candle? It's below this gap, right? Which makes it an inverse fair value gap. This is bullish fair value gap inverse. That's it. You can do that the same way, the other way around. You see this bearish fair value gap? Yeah, it got inversed here. This is an inverse of this bearish fair value gap. We closed above. Bearish fair value gap, closure above, candle closure, not wick, candle closure above, inverse. Bullish fair value gap, closure below, inverse. That's it. That's literally it. Now we're going to combine the steps a little bit. We're already breaking down the strategy. We were already breaking down the strategy here. You see, we said 50-minute liquidity is what we're looking for as the fundamental. 50-minute liquidity sweep, we want to see after. So after we spotted the liquidity, we want a sweep of that. And then once we get the sweep, we want to go to the 1 minute time frame and see a change of direction. So we make sure it's not a takeout, it's a sweep. Because remember, this is a sweep of this liquidity, but this is a takeout of this liquidity, if that makes sense. You see the difference? Here we're just going up and not changing direction. Here we're changing direction, which means we're sweeping that liquidity. That's it. So we said on the 1 minute time frame, we want to change of direction with an inverse fair value gap. So as an example, so you understand now, you see, we swept. This is buy side liquidity. We're going to sweep it. While sweeping it, okay? While sweeping it, you want in that move, while sweeping it, a bullish fair value gap. You want me to show you an example? That's not a problem. I can do that. I can just do that by looking for liquidity. Hold on. Or, yeah, just randomly, okay? Let's say this is the liquidity. I already know by looking at the 1 minute time frame that this is 15-minute liquidity definitely as well. So let's say this is the liquidity, and you see while sweeping it, while going through it, while touching it, we get a bullish fair value gap. And that's exactly what we want to see when we're sweeping buy side liquidity. Buy side liquidity, 50-minute sweep. Then you go to the 1 minute time frame and you see a bullish fair value gap while sweeping it. The only thing now you're waiting to see is a candle closure below that fair value gap. You see it right here. You see it right here. And that's literally it. That's the strategy. The strategy is if we see 50-minute buy side liquidity, we want a sweep of it and a fair value gap, which was created while sweeping it, inversed. What is this setup? This is a setup now because we have confluences aligning. This setup is telling us to look for a short position now. Why? Because we swept buy side liquidity and we inversed a bullish value gap. That's it. Boom. Now you could have went short when that candle closed, and you can stop loss placement. We can still talk about stop loss placement and TP placement, which is important, I think. And you can do your stop loss placement somehow you wanted, and your TP placement. In this case, yeah, TP, did it get hit or not? Yeah, later it got hit. You see, boom, and got hit. And that's how you could have made 2.1x of what you risked, whatever you risked. I think now it slowly will make sense to you, because you know it might be still a little bit confusing to put all the steps together, but that's why it's very important to watch it step by step and learning it, and not just rushing yourself into it. That's why it's also important to rewatch and take notes. Now, for you to understand stop loss placement and TP placement. So you already saw that if you move your if you move your TP very small, you get very small factor of what you risked back. And so this risk to reward, let's say 0.5, doesn't make sense for you to take, obviously, because you're risking, let's say, $100, and you're not even getting back your $100 if it's a winning trade. You're only getting back 50. Bro, why isn't it changing? Yeah, you're only getting back $50. Why? Because you take your $100, which is your amount of your risk. It could be, we're just talking about $100. It could be also $1,000, which is then $1,000 risk times 0.5, which would be then $500. But does it really make sense to risk $1,000 on a trade and then looking to make $500? No. So that's why you go for at least 1-to-1, which is you're looking to make back what you're risking or make the same amount you're risking. And better is even like around 2, if that's like what you aiming to make. I think 2 is solid, and you'll definitely get a lot of losses in order to master this risk reward. But once you master it, you can literally see that you can just double the like, not double your money, but it's just what you risked, you make 2 times back. So let's say if you lose that trade, if that trade would not have hit TP, that hit trade went into your stop loss, you're down 1K. And then let's say again you try to long here, and again your stop loss got hit, and again you risked $1,000, and now you lost again. So you're down 1K from that trade, and you're down 1K again, which is 2K down. But then you somehow hit a win. You hit a win with 1-to-2 again, 1-to-2 risk reward, and you again risk 1K here. But because it's a 1-to-2, you don't make 1K back, you make 2K back, because your risk to reward is 2, which then makes back your 2 last losses. You see, this is a loss, this is a loss. You lost 2 times, but then you won and you made back. Bro, it literally looks like casino to some people, or like gambling or something like that. But once you understand how strong you can be in those markets, when you're a calm person, when you try to control your emotions, it's not even only about trading. You can become such a disciplined, calm, patient person. This is so good. Like I've had such a character development through trading, and I'm not even kidding right now. So this is not gambling. This is definitely not gambling until you treat it like gambling. Unless you treat it like gambling. Because that's what I wanted to say. Because like everything is like how you treat it. Everything is like how you treat it. If you treat this shit like gambling, it's going to treat you back like gambling, and you're not going to make any money. If you treat it like a system you follow all the time, we just said before, what is it? A trading plan. Now let's talk about it a little bit. What is a trading plan? A trading plan means we just broke down the whole strategy, so you're now good to go to what to do on chart and what to practice on chart. But of course, not just, oh, I saw 50-minute liquidity, 50-minute liquidity sweep, 1 minute inverse for value gap. Now I'm taking a short. And just randomly taking trades isn't it. You have to have a plan which tells you when and what to do something. Did we talk about market hours already? Bro, my bad if we didn't. But if we didn't, I'm going to tell you now real quick about that. So the market has sessions. You can see those sessions here. And now I'm not in Dubai anymore. I'm in, let's say, Berlin time zone again. And you can see, you can just type in your time zone here. You can select it. And then you can see by moving the slide what session is opening. So you can see Tokyo session is opening at 2 a.m. and London session is opening at 9 a.m. 9 a.m. for my time, and New York session at 2 p.m. The most important session for me is London session because it gives me most of the setups and just it works out good for me. But the New York session is pretty good as well. What you want to do is you don't want to trade the whole day, obviously. You want to take out one session of those, which I recommend. Like, I don't recommend trading during the night. So, Tokyo session is not an option for me. Or is like Sydney session. Yeah, Sydney and Tokyo session both are not an option. When London session opens, like, I recommend to trade only one, either London or New York session, because both you can see down here, you see it says trading volume is usually low at this time, and now right now we're in Sydney session and the volume is on red, which is low. And you can see once we get into London session, see it turns out to be high, and it goes even higher in New York session. So that's the time when price is moving very well and it's good to trade. So I'm thinking about not overloading you with a whole lot of knowledge or a whole lot of info in that video, because like it has to be a little beginner friendly as well still. So I think this is already solid fundamental and foundation for you to actually get started with this shit. Now we can maybe talk about like MetaTrader and all that. So as I said before, MetaTrader 5 is the app you're going to download on your phone. And once you download it, it's self-explaining. You're going to see an option to create a demo account. I would recommend you to change that. If it's a 100K account, to change it to a 10K account. And a little, like, I'm going to give you a few steps now how to move on after this video. So if you're a complete beginner, if you didn't know anything before that about trading, and now you obviously know something about it, you want to look at your whole notes, watch this video maybe again, and refine those notes. If your notes are already very good, then you're going to go download TradingView and MetaTrader. And the first thing you're going to do is go on TradingView and go on the Euro USD chart and try to find these things. Try to find the strategy, try to find the highs and lows on chart. That's what your task is for now. You're going to go there, just test, just practice, just find these things, mark them out on chart, all the liquidity and all that stuff. Also, if you're wondering, okay, this also liquidity, it's standing out, but it contains 4 candles. For me, this is not like, there is liquidity laying, but I would prefer something like that maybe, or something which is which is 2 candles, if that makes sense. So for example, this is also kind of 3 candles, but these two are standing out, so I would just mark it out like that. Yeah, that's it. Not like that, like that. Yeah, we're talking about MetaTrader and the steps you're going to do, and just testing out, practicing on chart. Once you know, okay, now I know actually how to mark these things on chart, what you're going to do then now is you're going to go on replay mode, on bar replay. If you don't have that option, please just buy it. It's not very expensive on TradingView. So you buy the plan, which gives you the replay option. And what the replay option gives you is you can literally go to select bar and just You see, replay the price action, which allows you to practice liquidity sweeps and just a strategy. You can back test a strategy. So let's say this is liquidity, and you see this is in this case not a sweep. Why? Because if we mark out that sell side liquidity, we don't change direction after touching it. So we don't go like this, we go like this just, and this is more like a takeout to me. So it's not a sweep, but yeah, that's exactly what you can practice on backtesting on bar replay, because you can just, okay, now like it's still not a clean sweep because we change direction way too late in my opinion, but you can, that's what you literally learn there. You learn to see market, you know, just not opportunities, what is it called, different things. You collect knowledge, you collect experience on how to mark out, how to see these things, and you see so many things. Yeah, that's just information and practicing. After doing that a while and realizing that you're doing very well, what you're going to do is finally get to use your demo account on MetaTrader 5. Before that, you're not going to use it because you're just not trying to gamble, even if it's fake money, but it doesn't make any sense to press random buttons there to see some numbers going up and down because you don't know trading yet. Obviously, you cannot really trade yet. So for now, you learn on chart things. Once you learn that, you go to the MetaTrader demo, and now we're getting to the real stuff. Let me give you example. So let's say your strategy setup is showing up. Let's just make a example, okay? Let's say you had spotted liquidity somewhere here. Let's say somewhere like this. So I just marked out 15-minute liquidity and went to the 1 minute time frame to look for a sweep, to look for a change of direction, which we did get. And while sweeping that sell side liquidity, we created a bearish for value gap, and this bearish for value gap got inversed. You see, with this candle we didn't close above, but with this candle we did. And because of the closing above, boom, you can consider taking a long trade, a long position of that. Stop loss placement, I can tell you a little bit about that now, not too in depth because the video will be way too long then, but stop loss placement is something you either place it on the new liquidity, which is created through the sweep now, which is this in this case, but this would be too big, which makes you put your TP way too big then as well, because you don't want to get that little risk reward. So you can just look at it by seeing it. This is too big. If you're a complete beginner trader, obviously you don't know what is too big and what is not. So you just move, like I say, you want to see your stop loss in the size of around that. On Forex, on Euro USD, you can just look at the pips, and if it's around like 4 to 5 pips, then it's good. If it's about 4 to 3 pips is also good, but in this case I would feel safe to put it below the inverse for value gap like this. This would have been too big for me because this is already not offering me a good trade. You know, it's not offering me a good trade because I would have to put my take profit way too big, and it's not really worth it. A really big move of the change of direction, which we want to catch, already happened. So I better make my stop loss a little smaller and then just go for a quick little move. And for take profit, it's pretty easy when you have a good stop loss placement. But for the take profit, you always want to target highs in this case, or lows. So if you go short, highs or lows, or for value gaps. So let's say this for value gap, you can target boom like that. You can just target it and you get a 1 to 2, just let it play. You see it worked out here. And that's really it with to take a trade. And the real game I wanted to give you now is, let's say you're actually trading that on Forex, on Euro USD. You go to your MetaTrader, you go to your, let me check real quick what it says there. It says on Euro USD, it says like on the bottom left, you go to quotes, and quotes is where your all symbols, all your pairs are going to be shown to you. You press on enter symbol for search if you have the MetaTrader app now, and it will be good if you follow my steps. You go to quotes. If not, just stop the video and then download it, and then you're going to see, go to quotes, type in Euro USD, and type in like that plus sign, which will add Euro USD to your list. Now I have it on my list. I press on it. It says trade, chart, details, statistics, or delete. You want to go to trade. Now you're going to see how it looks like before taking a trade. You can see sell by market or buy by market, and in the middle you can see you can type in a number, which is going to be a white number, and that number is going to be your lot size. That lot size is actually deciding how much you're going to risk on that trade. So let's say this trade you're planning to take, okay? And you can see your stop loss is going to be around 5 pips big. We already talked before about it. This amount is how big the stop loss is in pips. 5 pips in this case. We're on Forex. It's not the same for Bitcoin and all that, everything, but right now we're talking about Euro USD. This amount is pips, this amount is the points. Now I'm going to give you a simple explanation of the pips and points in money. So let's say you type in 1 lots, okay? If you open the trade with 1 lot size, like with 1 lot, if you type in 1 and press buy or sell by market, every point you see these 50 points, because it's 5 pips every point. If you enter that trade right here and you place your stop loss here and you enter that trade with 1 lot, these 50 points are going to give you each $1 per lot size risk. So let's say I enter that trade here, I press here, right here, I press buy market with 1 lot size in there. This means every point we move down is going to be $1 minus. So if we hit stop loss, then it will be $50 down, because when we're talking about the lot size and the stop loss in pips, we're not really looking at the pips, we're looking at the points. Because if you use 1 lot, then every point is $1. Obviously, if you use 10 lots here, if you use 10 lots and open that trade, this trade is not going to be a risk of $50 because it's 50 points. It's going to be $500 risk. So it just depends on what lot size you use and how big you're planning to do your stop loss to figure out what amount you're going to risk. And you can see if you risk $500 on that trade because you enter the trade with a 10 lots and your stop loss is here, then you can look at your take profit, and let's say your take profit was right here. It's 100 points, and if you take that 100 points times 10 as well, because you always have to multiply the lot by the points, then you can see that you make $1,000 because you risked $500, which is here in the stop loss laying, and times 2, it's $1,000. That's really it. And that's the same for a short position. Let's say, just a quick example, you went short here just for some reason. Let's say for some reason you decided to go short here. You place your stop loss placement and you see what points is it. 25 points in this case. So if you would have opened that trade right here with one lot size, you would have had $25 risk. 10 lot size, 250. 100 lot size, 2.5k risk. That's it. Simple as that. I know I've been going a little fast with all this right now, but I just want you to rewind and just go through it slowly. No Diddy again, and then you're slowly going to understand it. Trust me. Now you already know way more than you knew before watching this whole masterclass guide video. And if you already got a lot of value from, bro, or not even, okay, let's even do the becoming profitable part first before wrapping the video up, of course. So when does the becoming profitable part come? I'm going to tell you now what it takes and what even is trading profitability, because people think, oh, I'm going to win a lot of trades and lose like 2 to 3, but make like I'm going to take 100 trades, lose like 10 trades or 5 trades, and then going to win all the rest of the trades because my strategy is going to be so good, and then I'm going to be profitable. Yeah, that's not the reality of trading. I already told you before, if you have a high win rate strategy, so if you win a lot of trades, then it's probably because your risk to reward is not big. And if your risk to reward in the average is big, then your win rate is probably low. So what makes a strategy profitable, I said it already before in the video, I think, is either long-term, either you're long-term with your strategy, the amount of trades you win is bigger than the amount of trades you lose, or the money you make with the winning trades is more than you lose with the losing trades. But that means you have to do it over a long time consistently. You have to be repeating that. And also, like, it doesn't have to be very complicated. So I know for you as a beginner, this seemed already complicated, but if you knew, bro, if you knew what other traders are trying to teach people out there, it's totally bullshit. Like 10 confluences, so many BS drawing on the chart, and doesn't even really make sense if you can really make it with that already. And I did it. And now my throat is so dry. I have to drink something. And but before actually wrapping it up, as I said, I'm going to talk about becoming profitable. It's going to be a very hard path for you emotionally, because most of the people are unprofitable in trading because of how they think and how they think and how they move. So the psychology, I said it before already, psychology is essential to becoming profitable. And most of the traders cannot master psychology. That's why they are unprofitable. What is even psychology? Do you revenge trade after losing a trade? Are you after making that money back? Then your psychology is bad. Are you very emotional and crash out when you lose a trade? Your psychology is bad. You break your rules. If you have a trading plan, that trading plan is going to give you like steps which you have to follow and things which you cannot or you're not allowed to do. Do you break those rules? So your psychology is bad. Are you getting overconfident after getting some wins? Your psychology is bad. That's all psychology. Like what situations are you putting yourself in which are making you do some certain things out of emotion on chart? It's all psychology. That means mostly people are unprofitable on chart, unprofitable in trading, actually are gambling because they don't know how to emotionally handle trading. How to emotionally handle trading is just having a strict trading plan. It's so good that you watch this video exactly because I'm telling you how real trading looks like long term. And if you have a trading plan, if you keep following it and refining it, what does refining mean? Let's say you use certain things on your strategy and you compare all the trades you had and you see some things are not working out very well. You cut them off and you move on with the new data collecting, and that's all advanced stuff like data collecting, journaling trades, like deep back testing, but I think forward testing is even better. So practicing on a demo and then getting a funded account. And also, if you're wondering, when should I get a funded account? I said already before, 2 to 3 months demo trading to practice execution, to practice how to trade. Then you could get a funded challenge, like a 10K or something, and then just try to trade on that. But I said it already before. That's also psychology. If you're low on funds and you go for, let's say you have $200 in your bank account and you go for a funded challenge, which is $100, you put half of your whole money for a funded challenge. Of course, you're going to be mentally and emotionally attached to that account. So, of course, you're not going to be able to trade without emotions on that account because you'd be like, shit, I cannot blow that account. I cannot lose that account. It's $100. But if you have $1,000 in your account and you buy an account for $100, you're not going to be emotionally attached that much to that account because you know if you lose it, you could buy another one easily. And that's all psychology. That's literally all psychology. And I cannot believe that people are stuck because of psychology years into trading. And I don't want you guys to be one of those. So I'm very glad that you found me, found that video, you found real trading. Because I saw a lot of people, and I'm seeing it every single day, even on my Instagram reels. Some like old ass traders are commenting and being like, "It's not that easy." Because I said something like, "If POVU, if you lock in POVU in 2027, if you lock in with liquidity and imbalance," and then I'm showing Dubai, and he said, "Yeah, the typical Dubai thing, and it's not that easy how you think. In 2 years you're going to be there just because of trading. No, trading takes longer, trading profitability takes longer. No, it doesn't. Wake up. I know you're old and you've been in this markets for 25 years. I don't care, because right now we're talking about funded accounts. We're talking about prop firms which give you money just to trade, and after proving them you're profitable and reach profit targets, you can literally withdraw the profits which you make on their big accounts. So no, we're not stuck into the old ass idea of trading. What is the old ass idea of trading, of collecting $100,000 and putting them onto a trading account and then trying to become profitable, and which takes 5 to 10 years or something like that. No, we're over that. You can milk prop firms. You can get 5 to 6 figure prop firm payouts and then start your personal account from there, like I did. So I hope I didn't went crash out now at the end too much. But I literally got tired as well, like after talking so much without any breaks. But I'm proud of myself that I did that now, and I'm glad that this video was, like, I know this video is going to help a lot of people, so I'm glad I'm done with it now and we can wrap it up now. But if you have any questions still left, you can comment down below, and even like either I reply on them, or you can just follow me on Instagram as well, Glory Trades, where I often will do Q&As. And if you got a lot of value from this video already, the first link in the description, and I'm not going to cut this out. The first link in the video description is going to be my premium Discord, where you get weekly live session to Q&A and trade reviews, where you get answered all your questions. A community, like a like-minded community, supportive community. You can ask your questions that are going to help. Everyone's helping each other. And my strategy in depth and exclusive videos about psychology, which is the most important thing. So you're getting a lot of value in that premium Discord. And if you're actually trying to lock in and accelerate the process of you becoming a profitable trader, you can just join there and make sure you're on a good path. And yeah, I would say that's it with the video. I would love a like and a comment of how you liked that video. And that's it. Stay hard, guys.